Hi, everybody, and welcome along to the Mint Monthly Update for the segregated funds. You've got myself, David Fyfe, and John Middleton, our fellow PM, joining us to update you on the month of September. Just rolling through the wee disclaimer there. In terms of the month of September itself, it was an interesting one. A lot of macro data more so than corporate data. And again, it was a big focus and a big driver of outcomes over the month. And thought I'd throw a few charts in to start. On the left there, we sort of saw from the QSBO survey and also from a GDP print for the last quarter, things have been pretty negative still in terms of the country sort of double dipping into a small recession. And as you look on the chart on the left, the optimism from businesses, we've seen it with the consumer as well, has often been well ahead of where own activity is. And I guess the real question from here, and obviously this was a key driver of the 50-point cut by the RBNZ, is really, which way are we going? Is activity going to pick up, or are we going to see, in terms of optimism, drop back? But it feels there's a little bit of both there, with some green shoots occurring in some sectors throughout the economy. And then just on the right there, we've got what we call the nowcast from the RBNZ, which is showing expectations of GDP for the quarters ahead. And obviously you can see that blue line there. We obviously thought it was going to be negative, and then the actual outcome is the dot at the bottom, which was far below expectation. Now, a couple of nuances, but in general, looking forward to Q3, Q4, the black and the red lines, we are expecting it to pick up a little bit, or the economy, but obviously even then we're sort of pulling it back a little. And clearly that's why we've seen the RBNZ, and obviously with the new governor in almost, we have seen that 50-point cut move. So that should be somewhat supportive to support activity in the near term. In terms of the funds itself, the Mint SRI fund was a strong month for New Zealand equities, up almost 3% after a couple of strong months, to be fair, in a row. And across the month, there's been some strong supporting sectors, and obviously the REITs have been a big part of that, up well into the double digits over the last quarter, but another strong month for them as well. As we said, not a lot of corporate news in the quarter, a couple of small retail updates, but really the big ones that have taken up our time and myself individually was Infratil Investor Day over in Sydney. Now, again, this was more sort of on-track story from the guys at Infratil. And again, the charts I've put on the screen here, looking at the main asset they own, CDC, the Canberra data centre business. It really is the driver, with over 40% of the value of Infratil sitting within this. And the charts on the right there just show the expected growth in data centres throughout Australasia over the next few years, and more than tripling in terms of megawatts or gigawatts. But also, if you look at the bottom chart, that's availability in terms of vacancy, and showing that it's actually pretty tight. So, while we do talk and hear a lot about the bubble in AI globally, in terms of specific regions and availability, it certainly still remains tight. And in fact, shortly after the update from Infratil around CDC, we did hear them sign another 100 megawatt contract. So it's supportive. Now, outside of the key asset in CDC, Longroad is the US solar development business, sort of come through the trade tariff issues with reasonably unscathed, continues to track along nicely. I guess outside of that, they've also got the 1NZ business, and unlike Spark, it's actually done okay in the medium term in the last while, and they've sort of stuck with their medium term EBITDA margin targets, which they will get to eventually. But in the meantime, the focus will be on cash flow as they continue to spend a little bit of capex. The one we're keeping an eye on that could be interesting, but we'll see in time, is Gurin. That's actually the renewable developer within Asia, and they are bidding on what is a very large project between Singapore and Indonesia, and that could be quite a big win for Infratil and their business if they do succeed in winning that. We'll find out probably next year, so one to keep an eye on. In terms of other names, Scales provided an update that they'd bought some of their companies they had JVs with or partners with already, in terms of their global proteins business. Now, Scales have had a cracking year in terms of the horticulture and apples, but on top of it, they've had a more steady return out of their global proteins business. And really, it is the driver, and especially the use of their marginal capital from here. And so we saw them buy 50% stake in Meteor Australia that they didn't own, as well as the Famer International business. So these are pretty solid businesses within the global protein and pet food businesses. And again, now consolidating them on the balance sheet, they gave an update of where earnings guidance will go to. Not natural upgrade, but just consolidating. So overall, it's a positive. And of course, they used bit of script, but largely balance sheet to support this, with a business that was net cash and using a little bit of debt. It's a great outcome to shareholders. So we remain overweight the name, and in fact, as you can see there on the chart on the left, there was actually a positive attributor over the month. So it's a name that continues to do well. And so for the fund, it was a reasonably okay month. We continued to add to a few names around Vulcan Steel, looking at some of the cyclicals. Cyclicals have been a strong performing sector in the last few months, so that's one we've sort of added to from there. And then THL also had a very good month as well, on the back of sort of some tourism optimism from here. I'll now pass over to John to touch on AET.
Yeah, thanks, Dave. So looking at the Australasian Equity Fund, as Dave alluded to, obviously a very good month for New Zealand market, up 2.8%. Although interesting to see that Australia, the ASX was a laggard, indices falling between 0.8 and 1.8%. So Aussie sort of missed out this month. Within New Zealand, again, it was a slightly bifurcated market. Interest rate cutting and sort of the more macro tailwind side of things has pushed mid caps and small caps more aggressively than the larger names. So mid caps in the NZX 50 were up 5.1, small caps up 6.7, but actually the larger end of town was only up 1.6. As I mentioned, Australia was a bit of a laggard. Interesting enough, gold stocks were up 25% on about a 10% gold price increase. So a lot of support in their direction. And I suppose the other big move sector-wise was energy. Basically, it's a sector off about 9% when basically Abu Dhabi walked away from the Santos deal. And I think the general tone, while in NZ, more recently we've actually had a 50 basis point cut, but the expectation was for rate cuts going forward because of a slowing economy. Certainly that inflation print in Australia earlier in the month meant that the RBA got a lot more hawkish, and hence no cuts for them probably until the middle of next year. There was limited sort of specific stock flow news. Obviously, Dave's mentioned the Infratel Investor Day, but not much other than that. In terms of performance, again, Infratel did well. A2 gave back some of the gains from last month, so a little bit of a positive there. And then amongst these sort of other names, I'd say WiseTech, was a sort of weighing on the performance of the fund. No obvious reasons there. Again, no specific news flow. There was a little bit of director selling, but to be honest, that's normal. Arguably, the freight names came under a little bit of pressure, even though I think, with the sort of grind of tariffs moving forward, we are starting to get a bit of visibility on freight flows. Yes, there was a lot of freight sort of moved around ahead of the tariff deadlines, and that's abated a bit. But other than that, nothing much. So I think WiseTech a bit of a momentum play at the moment. Having said that, we still do very much like the E2Open deal. I see there's a massive opportunity, particularly combining the strength of WiseTech on the land side of the freight business with E2Open's port side or container side of the business. So have been picking up a little bit of WiseTech. Freightways had a good run. Again, it feels like it's the bellwether for the New Zealand economy. So I think it's the means in which people have tried to play rate cuts in New Zealand. Great business for us. It's probably fully valued here. Clearly, there's an opportunity to do an Aussie acquisition, but I think that's largely priced in here. In terms of moving the fund around, yes, we have sort of moved a few things. We've added back a bit more Vista. We've bought a bit of Macquarie Group and added a bit of Goodman Group on weakness, and again sold a bit of CSL, Ryman and Spark. Hopefully, the chart on the right highlights market moves over probably the last 3 months. It's a similar chart for 1 month as well, but obviously not a great month for our style, which is high quality growth names. Clearly, those 3 factors, including quality, meaning strong balance sheet, have actually been underperformers of late, as the prospect of interest cuts has driven the more cyclical and yield focus side of the market. So a month of underperformance, but expectations to hopefully recruit that going forward as this trade we see is largely played out. Moving across to the property fund. Again, a very strong month for the index, up 5.8%, and a great quarter in total, up 14.6%. Again, interesting to see Aussie property was actually off as well, only 30 bips down. But again, talking about the RBA's no cuts going forward has clearly weighed a little bit on the sector. I think, again, as we've talked about in previous months, we see this as sort of the yield TD trade sort of continuing. The fact that we are getting rate cuts means that term deposits are continuing to fall. The good news is so are mortgage rates. But for the property sector, which has a lot of debt, that is good news. And also the property sector has pretty compelling yields, gross yields of 6.8%. So I think we have seen, the market trying to maintain income by moving towards the sector. Again, in terms of news flow, not much out there really. There was a transaction, albeit it was an in specie one. Basically, IPL bought the Silverdale shopping centre off Stride for 114 million. But the good news there is we are seeing more transactions, so a little bit more liquidity in the market and willing buyers and willing sellers, albeit with interrelated businesses. We also saw Goodman Trust get all its approvals for its Highbrook fund. Obviously had a bit of investment from Goodman Group and a couple of others there, but the reality is the fund is set up and ready to go now. In terms of the fund, again, similar to the things that we've been talking about, the higher quality names seem to be, more fully valued. So we've been going after a little bit of high yield, buying a bit of Vital Argosy, and actually moving a little bit more of the fund into Australia through Goodman Group, and funding that through exiting small positions, which have done reasonably well, NextDC Channel, and a little bit of GMT here in New Zealand. Looking to the chart on the right, I thought this is, one of the things we've been talking about over recent time. This is essentially the NZ REIT sector relative to NTA, so the tangible assets of the businesses over time, a 20-year time frame, so reasonably long term. But as you'll see, this is sort of the cycle. Obviously, things peaked in COVID and have been under a bit of pressure in recent years with high interest rates. The interesting thing is certainly in the last 3 months, and we've had a material outperformance which has moved the sector's valuation basically in line with book. So they're trading broadly at book value, and in relatively quick time. Within that there is still a bit of spread. Again, sort of the larger high quality end of town, the likes of Precinct and Goodman and almost KPG are trading at or higher than book value, while the smaller end of town, those with a bit more debt and less liquidity, the Argosies and Strides of the world, are still trading at a discount to NTV, but obviously that discount has materially loosened. So I do think, or shrunk. So I do think a decent chunk of the property re-rate has happened. What happens from here? Well, I do think property remains in focus, certainly from a retail perspective. The valuation gap has closed, but as I mentioned, you still get a pretty healthy gross yield of about 6.8%, which compares to term deposits of about 3.5%. So I think from a retail perspective, investors will be looking to the sector to try and replace term deposits. So I think there will still be more buying, albeit I think from the institutional side, we're seeing things as more fairly valued. The other point I'd note, and again, we've mentioned this before, is clearly as the sector moves to book value and probably to a small premium, we would expect a number of the constituents of the index to look to raise a bit of money to either, repair balance sheets, which probably had too much debt in going into the downturn, or basically to fund future growth. So, as we go through that book value to a premium to book, we would expect some capital raises going forward, maybe even ahead of the Christmas period. Anyway, I hope that was of use. As usual, if you have any questions, please drop us a line at info@mintasset.co.nz or give us a call. We appreciate your support and look forward to talking to you in a month. Thanks.